now we are in the section of savings and investment, which is an important part of accounting, national income accounting, so to say. And we will realize why this is important. Now, apart from the importance that savings investment has in accounting, it also has a huge importance in macroeconomic theory, because actually all, I think all macroeconomic models or all equilibria of macroeconomic models can be stated as savings equal to investment, savings being equal to investment. So that is why savings investment always takes a very central part of macroeconomics. So if I deal with simple Keynesian model, ISLM, even Solo's growth model, everywhere there is a savings investment interpretation, at least a savings investment interpretation of the equilibrium. And it is necessary that we know that in each and every model. That's very important. So because of that, we must know what constitutes these two things in reality and how they balance in accounting sense. Okay. So first we'll start with the famous term wealth. So what is wealth? Obviously it is pretty simple. The value of assets, own assets obviously, or one assets, so owns, that is what we have. Okay, the value of assets that is owned by us. Sorry. Less the value of liabilities. Just to make kind of simile, O's is called wealth. So essentially wealth basically means assets minus liability, and that goes for individuals as well as a country. But obviously in case of a country, these valuations and first of all characterization and then these valuations are quite difficult. And just to say, for an individual also, at least year to year, we must calculate our wealth. That is important, okay? Because nowadays, going for EMIs, which are nothing but liabilities, is common. So because of that, we must do this. All right? This just as a passing suggestion. Anyways, so here we are, obviously interested in national wealth. So obviously, we go by this definition of wealth. Well, then national wealth is basically wealth of an entire nation. So there is nothing, at first glance, there is nothing much to understand. Now, the most important determinant, of wealth is the rate of saving. So we will not like to be wealthy and not like to live in a wealthy nation. So to that extent, the rate of saving is really important. And as we know, saving is basically income minus your consumption. So that idea also directly comes in our mind. Anyways, so rate of saving is basically, just to say, rate of saving is saving divided by income. So, think that we really understand. Now, measures of aggregate saving. Measures of aggregate saving. Number one, aggregate saving. Okay. Number two, government saving. Sometimes called public saving. And then number three, this may not come as a surprise, which is national saving. So by that, we readily understand what national saving is. National saving is basically the sum of these two. So we are now going to look at a table, and which will go into the details of these three measures. Savings measure, and then on the right side we have definitions and formula. Okay. So first component, as we look at here, private savings. So in that we have, as we said, private disposable income less consumption. S private is equal to, so Y, that is income, then NFP, which is net factor payments, sorry, net foreign payments, I think, then minus tax, then plus transfer, then some international component, INT, minus consumption. Okay. Yeah, NFP, net factor payments from abroad. And so just to say it again, income, this is net factor payments from abroad. Okay. Then this is tax, this is transfer, and this one is interest earnings. So, interest earnings. And the last one is obviously consumption. Okay, so my income from the domestic resources, and then income coming from the foreign countries, then interest income which comes from bonds, stocks, and etc. Then transfer, if somebody is giving money unilaterally. From that we must let go the tax that you have to pay and the consumption money. Okay, so that's the idea. Okay, now we move on to government saving. Which is pretty easy to understand. So that is government receipts, money that we have, less government outlays. So we will write it as S government, which is equal to, so tax goes to government's home, then transfer, which is given away, and then interest payments, which government gives to others. So this is net interest obviously, and minus, ultimately minus G, which is the government expenditure. And as we said, national saving is basically the sum of these two. So we will write it as S, so this is S private plus S government. If we sum them up, then it will be Y plus NFP minus C minus G. Okay, so those are the things that you have to deal with. Okay. Now, first thing that we must state is that there is a component of investment also made by private sources, but that investment expenditure that does not come under the calculation of private saving that we have done here, and there is a reason behind that. Okay, so let's note that. Investment spending is not subtracted from private disposable income because we'll write like this, because such spending satisfy future and not current needs. So that's why investment never played a role here. Okay. Now, since we know government spending, the next component that comes in discussion is called budget surplus. And obviously, what it is the money that is saved by the government from the budget. So tax is its income, and then G plus TR plus INT, which basically means that we are talking about government saving itself. So then the idea is that the savings of government, if it is positive, then it is budget surplus, and if this is negative, then it implies budget deficit. And in a country like us, we are more familiar with the term budget deficit rather than budget surplus. Okay. Now, private saving is an important component, obviously. Something that we saw when we talked about open economy accounting, that private saving can really play a role in creating a balance between the government saving and the trade balance. So that's why uses of private saving, because a high savings rate means a lot of things for a country as well. Obviously, not all of them are really benefits. Let's see. Now, so we know that, okay, so let's write like this: S private is equal to, let us rewrite the equation, Y plus NFP minus C minus G. Okay. So just for the time being, okay. Sorry, not private, national saving. So S equal to Y plus NFP minus C minus G. All right, now here we are going to plug the NI accounting identity for an open economy. So Y is equal to C plus I plus G plus NX plus NFP minus C minus G, and we're going to write that as Y equal to C plus I plus G plus NX in an open economy. In an open economy. Okay. So now, if we remove the brackets, then S equals, so I will remain, and we are going to just keep it out separately, plus NX plus NFP. So net export and net effectiveness from abroad. Now, we have seen the calculation of current account. That means what? That means that the term NX plus NFP. So NX is basically net exports, which is technically speaking the merchandise export and import component, and then comes the net factor payments from abroad. So this term is called, it's essentially this is called the current account balance. So this is our old current account balance that we have seen in open economic accounting. And we know the symbol is CA. So what we have is S equal to I plus CA. Now this S, it is national saving. So that means it is S private plus S government equal to I plus CA. And now if we want to look at the uses of private saving, it's pretty simple. S private is equal to I plus minus S government plus CA. So by this equation, what we see that three ways of using private savings. What are those? So number one is obviously I, which basically means firms borrowing from private savers. Number 2, this is minus S government, so essentially budget deficit. So here we have the same borrowing for private borrowing from private savers by government. It's the same thing, that's why we're not writing. And the third, just to mention, we know, third is CA, so current account balance. Okay. Now, we started with national wealth. We said that ultimately it is our point of interest. So before we go to that, we must just say that savings is a flow and versus wealth that we are concerned about is the stock. So it's a flow variable, savings, and wealth is a stock variable. And what is the relationship between stock and flow? So a flow variable is the rate of change of the stock variable. So by that notion we can write that savings is the rate of change, savings is the rate of change of wealth, and since wealth is asset minus liability, that means it will be either accumulation of assets or reduction of liabilities. Okay. Now, national wealth has two components. So, national wealth technically consists of two parts. Number one is nation's domestic physical assets, and number two is domestic, right? So nations foreign assets. And now probably we realize the role of official reserve transaction in all of this. And obviously we must write note here that problem of measurement due to problem of measurement, human capital assets is not usually included. Now, isn't that, now think of its effect, just to say, because since we are studying, we are actually talking about human capital assets. We are inside that. So now, if it is not usually included, that means very, it can have a dangerous consequence, by which we mean that we can have a nation which has a huge national wealth and a huge level of uneducated people. And we can have a nation where the national wealth will be lower in paper, but with good education and health, the human capital assets, which is not usually going to be quite high. And the reflection of such a combination will only be available in society and not in paper really. But obviously, the result of human capital assets or of better human capital assets will actually show itself after a certain point. Now, what is net foreign assets? That we have seen in open economy accounting. We have observed that. But here we are to make another note, which is also interesting. Note: domestic financial assets, held by domestic residents are not part of national wealth because why? Because my asset is someone else's liability and someone else's asset is my liability, and we both reside in the same country. So obviously when I'll be calculating as a nation, they will cancel out. So that is the reason. So because the value of any domestic financial asset is offset by domestic financial liability. This is pretty interesting in the sense that it says essentially this: if you are going to buy a car and you go for a loan to a government bank or probably to an Indian bank, okay, that meant a very different thing compared to say if you go to Citibank, which is an American bank. Okay, so those things are a little bit different. Okay, so lastly, that means national wealth can be changed, or technically speaking, increased because that's what we are interested in. But also in terms of it is going down, we must be able to recognize that. So national wealth can be changed via two avenues. So one is obviously prime determinant savings rate. So change in and saving is the change in national wealth. So obviously the first one is by increasing the savings rate. That avenue is always there. And then number two is through this channel, that is by change in the value of existing assets change when we say the first term that comes in our mind is such as depreciation. So this is why savings itself becomes really important, because it is a part of it, it is what determines the national wealth, but also national wealth is determined by the value of the existing asset. And saving also has a relationship to investment, in the sense that I said that all macro models or all the equilibria of the macro models, they always have a savings investment translation of the equilibrium condition. It is very important that we, every time we go through a macro model, we ask the question, what is the equilibrium in terms of savings and invest?